Good afternoon and welcome everyone to the Trading Talk Uncensored live Q&A session. My name is Danny and I will give you the webinar today. The first question that we have today is, what is AvaProtect? Before I'll explain the product, I would like to explain a little bit about how we can even have access to the product. And as you can see, I'm actually logged into the web trader. Now, what we're looking at the moment is the desktop version. The desktop version, it's called the web trader, okay? But we also have an app and it's called the AvaTrade trading app. Now, unfortunately, AvaProtect is not a product that we can find on MT4 or MT5. Therefore, to enjoy this product, you need to use one of those interfaces, either the web trader on the desktop or the AvaTrade trading app. Now, to access the product, I can, one more thing to jot down, it's only available, AvaProtect is only available for Forex, gold, and silver. Now, how can we use the product? Let's display one of the things that we wrote down. Let's say silver as an example. So we can click in here, and then we can click in here to expand the chart. And then as soon as we click buy or sell, we're gonna see here this golden shield. Now you see that this golden shield here is gonna also activate, if I'll click on the golden shield, it's also gonna activate the box here. It's gonna mark the box. So I can do one of those to activate the product. Now, what this product does is actually AvaProtect, exactly as the name describes, can protect the position for a certain time frame. Okay, whatever we lost during that coverage will be returned, okay? And there is a fee when we are using the product. Now, the fee, as you can see, is displayed right here and will be according, it will change dynamically according to two factors. One factor is the size of the position. So at the moment, if I'll minimize and make it 0.01, and also the time length is minimal as well, it's 1 hour. So our fee will be $13.95. If I will extend the lot size to be higher, let's click here on the plus, we'll make it 5 times more, then our price is changing accordingly. The price of what? The price of the fee that we will pay to protect the position. Another thing that determines how big or small the fee is going to be is also the time duration that we select. So if we click on the plus to expand from 1 hour to, let's say, 3 hours, we can see how the price changes. 6 hours, it's even bigger. 1 day, it's even bigger. And 2 days is the maximum, which considerably increased the price from 13, which we had in the beginning, to 210. Now, even if I'll reduce this back to 0.01, we can significantly see that for 1 hour, it's 13.95, and for 2 days, it's 42. The reason that I'm showing it to you guys is because to use this product, I want to use it efficiently. I want to use the take profit and the stop loss as a reference to how much I can gain or lose. So if, for instance, I would like to buy now, just as an example, and I want my take profit to be $1 higher than my entry, then we can see that with 0.01 that represent 100 units, we can make $100. Okay? Now, if we will compare it with the fee, okay, which is $42, it kind of makes sense to pay $42 and to protect $100 loss, or to pay 42 and be able to make 100 safely. it's quite nice. Okay, it's quite nice. Now, what if we, for example, would use half of that as an example? Let's say, so 41888 plus 05, that brings us to 42388. Okay, as an example, and we're going to use the same exercise for the other way around. So this will be 388. Oh, sorry, we're going to add the one here. Okay, and now it's still okay. It's still okay. Not the end of the world, this comparison, but the fee, as you can see, is very close to what? Very close to how much we can gain or lose. So when I'm using this product, I want to maximize my profits, or if I lose, I want to maybe potentially lose a bigger amount that I can cover with the fee, right? It wouldn't make sense to do it like this. Maybe less. It would make less sense. I hope that the whole explanation makes sense. Of course, if there are any questions until this point, guys, feel free to let me know. One more thing to say. None of the values that I placed in here is guaranteed to happen. And a little bit of background, what the take profit and stop loss are. Okay, you don't have to remember that. I'm going to show you that it's written on the platform, but just as a side note for you to understand a bit better what I'm explaining. Take profit is closing the position with a profit when reaching the targeted price. Okay, is closing it with a profit. This is why it's called a take profit. Stop loss is closing it with a loss. This is why it's called a stop loss. Now, it's not even mandatory to use the take profit and the stop loss. Even if I'll open the position like this without the take profit and the stop loss, and I will lose the same amount, as an example, then I'm still gonna get it back. But the difference is, though, that without the take profit and the stop loss, I need to be responsible to close the position, because if I keep it beyond the protection, then the remaining time I won't get the losses back. I'm only protected until when? I'm only protected until the date that is displayed under the in here, okay, under the time length. As you can see, it will expire in 2 days exactly. Yeah, it's quite simple. It's quite straightforward. Again, it was important for me to show you this comparison so you'll be able to compose a position that makes sense and you don't, God forbid, end up paying a fee bigger than your profits or bigger than your loss, which it's not the purpose of this product. Okay, great. So we're just gonna take this and we're gonna paste it in our presentation. One more thing to say, which I think is also important. When the coverage is done, when the protection is done, we cannot re-protect the position. We cannot use the same values. I can open another position and protect it, but I cannot extend my coverage once it's expired. I hope that it makes sense. Now, let's see, the next question here is, can I make profits trading only a single instrument? Of course. There are people that does that. There are trader that does that. No one obligates you to trade multiple instruments, and no one obligates you to trade a single instrument. Of course, the profit or the loss is not determined by the number of instruments that we are trading. What determines that is primarily the analysis that we do and how the market fluctuates. But what is the difference still trading one instrument rather than to trade more than a single instrument? Okay, so if I trade a single instrument, one instrument, and I take a single position that I can either keep until it loses or make profits. If I trade one instrument, I have one option to make profit or loss. That's just how it is. Okay, if I trade only gold and only a single position, either it's going to make me profit or either I'm going to have losses. As simple as that, right? Let's add another line in here. Okay, if I trade two instruments, I have two options to make profit or loss. Let's extend it. We're going to carry on with this exercise just to convey a certain message, but I'm sure it will sink in very, very soon. If I trade 3, then I have 3, and I have 4, then I have 4. Now, why am I showing you this? Let's just a second, I will show you something nice right now. We're going to click on the arrow, we're going to click on the X, we're going to click right in the middle of the toolbar on this layout change, to click here and select four charts. Now, with those charts, okay, we've got crude oil, we've got silver here, let's have NASDAQ also, let's have coffee as well. Now, let's click here on the first instrument, click here buy, just to open the order entry. I think the specifications that we had wasn't too bad. So we're going to click on the take profit, click on the stop loss. We're also going to bound the entry to be 42 flat to have a flat result. And our take profit can be 43. Our stop loss can be 41. And this is a ratio of 1 to 1, and that's fine. We're going to jot that down. We're going to have silver written, as this is the instrument we are working with. Our entry, as we said, will be 42. And our take profit is going to be 40. We'll put it like this. Okay, maybe we'll just have it as a plain 42. Okay. No, like this is a little easier to understand. Maybe we'll keep it. I don't want to confuse anyone, but maybe we'll keep it. We'll keep it like this. So the take profit is going to be, like we said, $43. Just makes sense with the decimal, right? And then stop loss is going to be 41. Great. In this case, how much can we gain or lose? Since we've got 0.01, which represent 100, then we've got 0.0. Let's actually, you know what? Let's make it 0.1, just to make it a little more interesting. So we've got the 0.1, which represent 1,000, and now we can gain or lose 1,000. Okay, so let's make it the entry. We don't need to write anything in here. We're gonna put down 1,000, and here we're gonna write also 1,000. Great. So this is profit or loss. This is profit, right? Let's put a percentage instead. So we've got 10%, and in here we've got 10%. So this is a single position with silver. We're gonna multiply the same principle to do it also with oil and with coffee. We're just going to replace the numbers in here. So we've got crude oil. We're going to click on buy or sell. Again, just as a reference, we're going to use the same thing. We're going to use $1 difference. So our entry can be 64 flat. Take profit can be 65. Stop loss can be 63. We're just making a quick comparison, guys, nothing crazy. Let's make it one lot. Okay, this is not doable. In terms of the margin, let's make it half. This should be fine. Yeah, okay. Now, one thing that I didn't write is the margin requirement. I hope that you notice my margin requirement for silver to take this position. Let me just show it to you again. Was 4,000. Now I'm clicking on oil. I'm clicking again on buy. So we've got 4,000. Let's write it down. Write it down here. 4,000 margin requirement. Another thing that we are looking at now is oil. We'll also make it 0.5. And now we are at 7,000. Let's click on the take profit and the stop loss. We'll make it 64, this 65, this 63. Of course, all of this is without any kind of analysis at all. This is just to convey the difference between trading one instrument to multiple instruments. Okay, crude oil, this time it's 0.5. This can be, as we said, 64. And maybe we'll have it like this. And this 65, this 63. Now we've got $500 and another 500. This can be 5. This can be 5. Great. Next subject is coffee. We're going to use the same reference, 1-to-1. We'll make it 0.1 to have 100. And then we will increase we actually don't have enough margin for that, but we will put it aside because we're trying to explain how diversification works. So margin requirement is actually what I need to have available to open the position. And since we've got 3 and 3 to be able to open this position, we need to make this one smaller. So let's try instead 0.05. And now if we'll increase, we can make the take profit, the entry to be a flat 378. Take profit can be 388. And the stop loss can be 368. This way, let's flatten that out. This way we can make and lose the same amount, 500. Similarly to crude oil. Now we're just going to write here 0.05. Then we've got the entry, which we said was 378. And the take profit is 388. And then the stop loss is going to be 368. This will also represent 5%. So we've got 5 here and 5 there. And that's great. I'm just going to delete one of the phrases because the message, I think, is quite clear. And then what we're going to do is a simple, maybe we'll delete one of those things to have a bit more space, right? It should work. Yeah, so we've got this in the picture. And lastly, we've got NASDAQ. We'll click on buy. We'll keep it as 0.01. Oh, we didn't write the margin requirement for coffee, so we're going to try and do it like this, which is 1.8. Okay, this is the margin requirement. We'll place it next to the entry as we did with the previous. Oh, sorry. Now, let's also replace this to NASDAQ. And we can have it 0.01. Entry, we can have it as a flat 24,750. Our take profit can be $1,000 higher, and our stop loss can be $1,000 lower. Okay, this way we can make or lose. Maybe we'll have it like this, and then we can make or lose the same amount. We'll place the numbers in a moment. Okay, so we've got here 7. We're we're almost at the max. We don't even have enough margin to perform this, but there is no lower than 0.01, so we're just going to use it in our example anyway. Now, this is only to convey the message. This is regardless the analysis, guys. I haven't done any analysis to legitimate the values that I selected, okay? This is very random just to show you guys how it goes. Now, if I use this ratio, if I use this structure here, so we're looking at making or losing 10% with silver, same thing with NASDAQ, we're looking at gaining or losing 10%. Coffee 5% and 5% with oil. This is again using the same ratio for all of them. What is the difference between trading all of this or maybe only NASDAQ or maybe only coffee or only oil or silver? What I wrote here, if I trade one instrument, I only have one option to make profits or loss. In this structure here, maybe I can lose a little bit of money with silver, but I can make money with oil. Maybe I can lose a bit with oil, but I can make money with coffee. Maybe I can make money with, if I lose with silver and oil, maybe I can make with coffee and NASDAQ. So what I'm trying to show you here is the power of diversification. When we choose to trade more than one instrument, the instrument is not guaranteed to get to the destined price that we aim for. Even if we use take profit on stop loss, it doesn't mean that the market will go there. Yeah. So what this gives us is to be able to harmonize our strategy, losing from one place, maybe compensating with another. One thing that can help is, in addition to what we're doing in here, is also to adjust the ratio per position. So if this is a ratio of 1-to-1, this means that we have the same ability to make the profits and the loss are the same value. So this means that if we lose, let's suppose if God forbid we lose all of that, so we lose 1,000, 1,000, and 500 and 500. That's a total of 3,000, right? 3,000 possible loss if all positions are losing. Okay, now what if we play with a ratio to be 1/2, or we can call it 1-to-2 as an example. Let's suppose that the silver, instead of looking at it as a 1-to-1 ratio, we can maybe get the stop loss a bit closer to the entry, which will slice the possible loss by half. So now we're looking at making 1,000 or potentially losing a 5%. Similarly, we can make it 64.5 and cut this by half too. So we're looking at 2.5% versus 5. Same thing in here. So we can say 78. We can, instead of increasing it by 10, we can increase it by 5, which brings us to 383. And this also minimizes my possible loss to 2.5. Now, with NASDAQ, instead of having $1,000 difference, we can have only 500. I'm going to show you one of these variations to see how it works, to make a comparison. Now, if we if we minus 500, it's 24,250. Now, this means 5 instead of 10. So how does this work exactly? I have another webinar that we're doing, which is called the Ultimate Trading Webinar for Beginners, and then you can have the explanation a bit more into depths. But now, just to show you the logic behind what I did here. So in the beginning, we had 3,000 possible loss if all positions losing, and 3,000 possible profit if all positions are profiting, right? Now, what if half is profits and half is loss? So At the moment, it looks a bit different. Now the possible loss is 500, 250, 250, and 500, which is half, right? So now we're looking at 1,500 versus 3,000. So if half is losing and half is gaining, half losing, half gaining, what we will have is 750 versus 1,500. Okay, possible loss, possible profit. Oh, sorry, potential. That's okay. That is the difference. That is the difference. So even if a single position at the moment, okay, we've got here 1,000. Oh, sorry. Yeah. With this ratio, when we cut by half the, let's calculate it together. Okay, so we've got the possible profit is 1,000 plus 500 plus 500 plus 1,000. Okay, that's 3,000 if all make profits, and we've got 500, 250, 250, and 500. Okay, this is how I came up with 1,500. So if those two positions, as an example, silver and crude oil, they both make profits, 1,000 and 500. Okay, and those two positions are losing, 250 and 500. Then I can make 1,500 and possibly lose 750. Okay, if three positions are losing, 5, 250, and 250, that's 1,000. And if I make a single position profit, Nasdaq or silver, I compensate the whole thing. So basically, this is something you need to balance. I'm not going to tell you how to diversify with how many instruments or what the size of the position. The purpose of the past 10 minutes was to just show you the availability, and you should decide how many instruments, what's the size of the position, and how frequent to trade. Okay, this is just the general idea. So I'm going to write here, if I trade one instrument, then one option to profit or loss, or loss. If I trade more than one instrument, I have more than one option to make profit or loss. Okay, in other words, I could just write here to diversify, but to answer directly to the question, I preferred to write it like this. Now, the next question is, can I learn how to trade only from videos? Well, that depends. For instance, if I am a person who like to watch, videos, and I know that I'm committed, and I have the available time, and I have the I'm a person who can really make progress learning from videos. So maybe, yeah, when I started, we didn't have this sophisticated smartphone to watch all those nice videos, right? We had books and we had computers. So today everything is very accessible. You got a huge library here of tutorials. We've got the YouTube, we've got all kind of various content that we're giving you guys to enjoy, and of course you can learn from videos. I would say that the same way that there is the theoretical part and there is the practical part. I can enjoy the videos for the theoretical part, okay, and I can practice and all of that, but at the end of the day, the same way that I can't go to the gym after I watched training videos and I'll be strong, I can't watch videos and trade like a pro. I mean, I can try, but from my personal experience, it does require adjustment anyway. It does require the whole process itself, to choosing what instrument to trade and what strategy is the best for you, your personality and your lifestyle. It's a process that takes time. So can I learn how to trade only from videos? The theoretical part, yes. I highly doubt that watching videos only without to practice will get anyone to the desired level. So that's how I'm going to say it. But in terms of the way that we observe the information, it doesn't. I don't think that it makes a lot of difference, because it's very individual. Some people can sit hours and watch videos and remember everything and digest it very fast and go to the chart and be great. You know, but some people they don't. Some people they don't like watching videos. Maybe they like to read, or maybe they like a person who is teaching them personally. Okay, so that depends. That depends. It's difficult to say one way is the best, this way or another. So try, enjoy the wonderful content that we give, and of course, if you are a person who prefer to be taught, you know, on a personal level, you can have a senior account manager to give you full support through the process, as in addition to all of the wonderful materials that we have. So to answer this question, the answer is yes. If my personality allows me to do that, my personality is you know, I don't even know how to write it because it's very individual. So I'm gonna write here yes. The way that we consume the knowledge is dynamic and individual. Some people prefer to watch videos and can make progress, and some people can prefer to be taught directly or read. They are all great. All of the ways are great as long as we practice and we improve. It doesn't make a difference if I read a book or I watch a video or someone told me, someone gave me a lesson. As long as I understand and I can make progress, it's, to my personal opinion, is great. All right, so we're gonna paste the question in here at the answer. We're gonna paste it in our presentation. Let me just show you how easily you can access our videos on the website. Just a second. Actually, I'm gonna send you the link. I'm gonna send you the link in a moment. So you think there we go. I'm gonna send you the link in a moment anyway. So you will see that very, very quick. But just so I won't forget, let's click here. Okay, this is the default screen as we saw. Right here at the bottom above the chat, we've got here this YouTube icon or play icon, whatever you want to call it. And if I'll click on tutorials, right away, it opens inside the website. I don't even need to go anywhere else. I've got the videos here with everything. I've got here a list. This is fully, by the way, fully with sound and with subtitles. It's great. Okay, right away I can have access to the videos very easily. Okay, let's see what the last question is. Okay, what is risk reward ratio? Okay, so we already spoke about this, right? When we spoke about the diversification, risk reward ratio is the ratio between my possible profit to my possible loss. In other words, if I can make 1,000 and I can lose 500, okay, what will happen if I'll divide 500 by 1,000? Let's see. Then we get what? We get half. What is half? Half is 1 to 2. What if, for instance, I will, let's say that I can make 1,000 and I can lose possibly, let's say, let's take a number and unround number. Let's go 175 is an example. Yeah. So what's the ratio here? So if I'll divide 175 by 1,000, it's 175. Okay. And if I will want to know the percentage, how much in percentage my possible loss is out of the profits, what I can do is I can go possible loss divided by possible profit times factor, equals factor times 100. Okay, so let's do that together. If we take the 175 that we had, we multiply this by 100, what do we get? 17.5. So this represents 17% out of the 1,000. Okay, why is that important? Who cares about the risk reward ratio? Because as we've explained, when we diversify, when there is more than a single position in running in our account, I want to be able to balance my possible profit with my possible loss. It wouldn't make sense to me, as an example, that my possible loss will be, God forbid, 70 or 80%, okay, or something like that, ridiculous, because then I can just accidentally wipe out my account. But if I maintain those low percentages and I combine everything to a point, one more thing to consider. When we jot down this margin impact, what does that actually mean? Now, the margin impact is the interpretation of the value divided by the leverage. So if, for instance, I want to take one lot with let's say with coffee as an example. So we're going to click on buy, we click on the arrows, then in here we'll place one lot. So we will see this is obviously something that we can't do because the value is 378 and the margin is 37,000. We've only got 10. But if we do this 0.1, we see that the value is 37,820, but the margin impact is only 10% of that, which we need available to open the position. So when we diversify, we would like to pay attention to that. Why? Because if I do any kind of analysis, but I don't have the margin requirement available, I won't be able to open the position. Furthermore, another thing regarding the margin, in my account, my margin level is something that I always want to maintain. Okay, I want to maintain into appropriate level, because if I don't have enough margin, the platform will close my position. So when I'm opening a new position, or if I'm holding an existing position, I should consider my available margin versus the position that I'm about to take. Okay, if it's only one position and I'm only trading a single instrument, this calculator is not relevant for me, because one position is what I've got and this is what I have. But if I've got multiply, I need to accumulate everything, and so it would make sense. All right, now the next slide that we will visit, it will be the links to share with you, to save you the trouble to find it by ourselves on the website. So since we spoke about learning from videos, there is a whole new section that is called the education section. And I'm going to send it to you on the chat, the links. This is the first link. This is for more official kind of questions, the FAQ and the Help Center. Underneath is for a real account. If you're still with the demo, watching videos, but you want to get down to business and you want to practice with real market and real accounts, so this is how you can do it. And the Academy, which is, I'm also going to show you how to access it from the website, but this is super simple to do. So let's suppose that we are here. We'll click here to fold it down. We'll click here on the X to close it. And now here, right here at the bottom left, where we saw the tutorials, we also have the Academy. So we'll click that to get to the Academy. And as you can see, it's very, very simple to get access to all the education that we're offering. So I encourage you guys to try and enjoy. Now, the last thing before we say goodbye is to give you the Q&A one-on-one premium market review benefit. This is actually a coupon that you can give to your senior account manager to be able to enjoy a one-on-one premium market review. So you can enjoy that. Other than that, unfortunately, our time for today is up. So we have to say goodbye. You're all welcome to join us with next week's webinar. Until then, I wish you all best of luck with trading. Have a fruitful week and have a good day.